I would say that although, the past cycles are indicative or predictive of, how it's gone in the past, the regulatory changes in the U.S., I think, just trump everything. They're just huge. And so I think we still have another leg to this rally to go. And so I think if all these endowments come in, all these sovereigns come in that we're seeing, frankly, we're going to put the money to work, right? Because when we raise the money, we're not going to sit around for 5 years. We're going to do it, and our peers are going to do the same. I think the next 6 to 12 months are still big rally. Fun fact on the markets is when it has peaked in the past, it's when we've all been the most bullish, right?
Bitcoin's next 6 months could be unlike anything we've ever seen. As of late October 2025, Bitcoin trades around $115,600, up about 4% from the weekend. But beneath the calm, the data tells a different story. On-chain metrics reveal Bitcoin's illiquid supply has dropped by roughly 62,000 Bitcoin since mid-month, a sign that selling pressure may be building. Meanwhile, the Bitcoin-to-gold ratio has flashed oversold signals not seen in nearly 3 years, hinting at an imminent breakout. Analysts are watching the $115,000 level closely, with upside targets stretching to $120,000 to $122,000, where major liquidity sits. Yet, what's coming isn't just another cycle. According to Raoul and Dan Morehead, recent U.S. regulatory shifts are rewriting Bitcoin's future. Morehead revealed that endowments and sovereign wealth funds are no longer waiting. Once capital is raised, it's deployed fast. That's billions in institutional money flowing directly into the market. Morehead predicts the next 6 to 12 months could bring substantial upside, but he warns investors, the moment of peak bullishness often marks the top. This period could deliver historic gains and equally sharp corrections. Let's take you back to the interview for further insights. Please like this video, subscribe to the channel, and turn on post notifications for more content. Thanks for tuning in. Enjoy the rest of the video.
The debasement trade. How do you play the debasement trade? I've been talking about it for 12 years. And so, yes, we were there early, but let them get the glory. They're all talking about it now. It's kind of like, when your colleague did the BRICS acronym. I heard that yesterday in a meeting. The BRICS, Goldman Sachs coined that phrase in the 90s. And so, it's now the debasement trade TM. They have a trademark on it now. But it's great that it is a trade, because I think we need to think that way. That is the macro issue right now. Every government is printing way too much paper money. A third of the landmass of the earth is covered with trees, right? So there's no stopping the printing of paper money. There's plenty of paper out there. So it's coming, and that's why everything's surging, including gold, Bitcoin.
And so here's one for you. You might not have seen that. We use a global macro investor total global liquidity index, right, as our benchmark for debasement. The Nasdaq, since 2012, has a 97.5% correlation, and Bitcoin is about a 90%. So what you've got is the most single dominant macro factor in our entire investing careers. Yeah. We've never had one factor, because before we used to run diversified portfolios and we'd be figuring this stuff out. None of it matters. It's all one trade.
Yeah.
Which makes it super easy. I think it's the greatest macro trade of all time. We've both been in it, you particularly for a very long time. It's so simple once you see it through those eyes.
No, I very much agree with you. It is that simple. And you rarely get trades like that, where it's both simple and I would even say inevitable. You and I have been in some trades over the last 30, 40 years where, man, it's 55-45. Maybe it'll work, maybe it won't. If you hold crypto for 4 or 5 years, I think it's 90% that you make money, right? And that is a trade you can really pile into, because if you size it correctly in such that if it goes down 60, 80%, you can still hold it. It's a trade you can just sit with because it's going to work. And I think these macro forces are going to be driving it because they're, like you said, they're generational. We have so much, the interest now on the U.S. debt's way bigger than the spending on the military, infrastructure, anything, right? And as rates stay high and go higher, it just gets worse and worse. And it is hard, honestly, to see a way out. Once you really let it slide like this. Obviously, they should cut the fiscal deficit, get the debt down, all those things. But everyone on both sides of the aisle now seems to think it's fine. In our lifetimes, the internet analog has been overused way too much. But it's totally appropriate on blockchain, right? Because the internet is a bunch of protocols that move certain kinds of data. In the 90s, Milton Friedman said the only thing missing from the internet is an e-cash system, and that's what Satoshi invented. So it is the internet, right? And the internet disrupted every other part of our lives, commerce, communication, all that. They're still charging 300 basis points to swipe a credit card. Like, that's crazy, right? That is not going to last. They're charging migrants a month's wages to send money across a border. That's not going to last. Like, all those things are so obvious. And again, like, I was joking with Mike Novogratz once that we've been trading dollar yen for 40 years and it hasn't moved more than 20 points from 120 the whole time. Like, nothing ever happened. It's never moved. Whereas it's not going to be 300 basis points to an electronic payment in 5 or 10 years, right? And it's not going to take a month's wages to send money from the U.S. to Mexico, right? Like, all those things are so obvious. And that's why I think people really can just like push the chips out onto the table. It's a all-in.
Yeah, and once you see it as a technology stack that you can invest in, i.e. you get a share of it by the token, then you understand how something like stablecoins is so big because it's a gigantic use case that is geopolitically aligned with the US. It's aligned with the banking system. It's kind of aligned with everybody. So it's got a hyperscale and it uses the underlying infrastructure of blockchain. So number go up as well.
Yeah. I mean, that one is, such an obvious use case that, Satoshi invented something that's amazing. And there are a lot of really cool layer one blockchains, but they do have volatility. And a lot of use cases, people would prefer to not have volatility. So stable coins are, just such an obvious answer that they have to exist. Let's be honest, it hasn't served them well, right? Like, you get zero on your deposits at a bank and they blow up every, 20 years. And remember, hey, that's literally in the Genesis block of Bitcoin. Satoshi was so pissed that there was another 50 billion pound bailout of a bank that Satoshi created a 300 million person movement. And they throw 50 billion around in days these days. That's like nothing. Like, whatever made Satoshi pissed is tiny. They're doing trillions of bailouts now. So, it's funny. You go to a crypto conference and you talk about fractional reserve lending, they'll like call security and drag you out. But that's because you're like crazy person. That's what banks are, right? And again, harking back to that SVB weekend, we got all our portfolio companies together and we were just triaging whether anybody, had any risk or, anything bad going on. And there were, most of the companies were fine, but there were a couple that had literally all their money at that bank, right? And it was Sunday and everyone's freaking out, like, how are we going to make payroll? How are we going to do this? Because our money's locked and the FDIC's got it. Treasury Secretary's not going to move the money, all that. I'm like, Bitcoin, you don't need Janet Yellen's permission to send people their payroll in Bitcoin, right? And that day, USDC traded 87 cents on the dollar. And it was so visceral to me. I was like, I would so much rather own USDC right now than have a deposit in a defunct bank. And the point being, fully backed by treasuries is always going to be better, right?
I was in Europe in 2012, the European sovereign crisis, when the banking system went under in Europe. And people forget, this was why I went down the entire journey, because the Cyprus banking system. They took all of the deposits from the banks and bailed them in.
Yeah.
So as opposed to the government bailing them out, everybody in the country who had deposits got wiped out. It's like, holy shit, you don't own your money in a bank, and nobody in the financial systems own anything either, because it's all hyper leveraged and rehypothecated. And at that point, when you realize, okay, this game is not good.
Yeah. And I think that the typical investor in the United States and the 13 other countries that have never expressly defaulted in history kind of think they always get bailed out, right? Like, banks go under, the government always bails you out. But the trajectory of everything we're seeing, there's going to be a time when the U.S. doesn't have that kind of money, right? Like, they can't just bail you out. So, I'd just rather be in something that doesn't need bailouts, right? There's never been a crypto bailout. I think this is still very, very positive for.
But look at that though, and then look at the rise of Bitcoin lending.
Yeah.
How do we think about this? Because, we can't help ourselves. We build leverage. Humans build leverage. Even on a 70 vol asset, we're going to build leverage. And how do you think about that versus the kind of fractional reserve banking system or the inherent leverage in the banking system?
Oh, yeah. I hear you that, speculation drives, more speculation. And so some people do use crypto to speculate on crypto. But I think it's a very small fraction of the industry. Most people just buy it as a, store wealth or, for other reasons. Whereas the entire banking system's built on leverage.
The debasement trade involves investors betting against the erosion of fiat currencies from excessive government money printing. With governments flooding economies with paper money, this drives up assets like gold and Bitcoin. A global macro liquidity index tracks this debasement, correlating 97.5% with the Nasdaq since 2012 and 90% with Bitcoin, turning it into the key driver of returns and simplifying investing to one core bet over diversified strategies. It's seen as straightforward and nearly inevitable, offering about 90% odds of gains over 4 to 5 years if you weather 60 to 80% drops, powered by forces. Higher rates make it worse, and neither political party pushes for fiscal cuts. Blockchain mirrors the internet's disruption in finance, realizing Milton Friedman's 1990s call for e-cash to upend high fees. Stablecoins shine as a low-volatility powerhouse, geopolitically tied to the US and banks. Events like Cyprus's 2012 deposit grabs or Satoshi's fury over bailouts highlight why crypto skips leverage and bailouts, favoring self-custody, as when USDC hit 87 cents amid SVB chaos but beat frozen bank funds. Crypto lending adds some speculation, but it's minor compared to banking's full leverage base. Let's go back to the discussion and watch more clips to gain insights.
I agree the current administration's spot on. It is in the United States' interest to promote stablecoins because 99.6% of them are backed by U.S. treasuries. So it is very good. It's unambiguously good for the United States to have stablecoins be popular.
And the next big use case, because the financial system's clearly realizing that its opportunity is here and there's a race. The other one is tokenizing everything. And that seems a big deal. It's like NASDAQ and everybody's looking at this now and figuring it out. Robin Hood's, moving at lightning speed on this. How do you think about that trend?
Yeah. So, you and I agree that blockchain is going to change the world, but it's not going to change it overnight. And your statement of tokenizing everything, I would say maybe not quickly, And so there's a great, I'm on the board of Figure, and Mike Cagney's super brilliant guy. And
I love Mike. He's a great guy.
Well. He said, and he's the biggest tokenized real world asset entity out there. It takes homogeneity and ubiquity to want to be on the blockchain. And that is a great way to say it. Treasuries are the ultimate homogeneous product. Like, you do not care if you have the 3 3/4 of 2036 versus the 4 7/8 of whatever. You couldn't care less. And they're ubiquitous. Everybody on earth needs access to US dollars and probably would like interest. So US treasuries are great. And we're investing in a protocol called Ondo that does that. They already have, I think, 12 billion of that. Great use case, right? But we've invested in things to where we were a bit early, where we were trying to do like commercial real estate on the blockchain. Apparently they're illiquid for other reasons than they're not on a blockchain. That there's a reason commercial real estate's not on the blockchain yet. So what I would say is, although in the fullness of time, everything will be on the blockchain, treasuries, US dollars, like stablecoins definitely want to be on the blockchain. And as long as the US SEC wants stocks to be on the blockchain, it'd be great to have them on the blockchain. Yeah. The punchline is all these different DATs, like Tom Lee's Ethereum DAT, the MicroStrategy on Bitcoin. It's helping people get exposure that maybe the 40 Act doesn't let them get any other way, or maybe they don't have anything but a brokerage account. And so look at them as access vehicles. That's the first one. Second one is, I think they're superior to
But there is an ETF. So we've kind of got the access vehicle.
Yeah.
It's the implicit leverage on top of the vehicle, I think, is what people like, but it also what makes people nervous.
Yeah. So that is then kind of the next way to think about it. One of my partners had a great line that's a little bit oversimplified, but he goes, hey, what's the worst case on a DAT? That it trades at par every day for eternity? That's an ETF. And I really like that logic. Is ETFs are inert. They don't do anything. They don't increase the number of tokens per share. They don't do anything. And your default is it just trades at par every day. So a DAT has the opportunity to trade above that. It has the opportunity to generate staking yields and other income that a lot of ETFs do not do. And then the super important one is with successful financial management, they can increase the number of tokens per share.
Yeah.
And MicroStrategy is obviously the biggest and most obvious example. They grew the number of Bitcoins per share 76% last year. So paying a premium for strategy stock is rational. Like, it has outperformed Bitcoin. So those are the ways to think about it, is that if you invest in a digital asset treasury company, you certainly have some upside by multiple expansion, but most of the growth has been in number of assets per share. Most of the value growth in MicroStrategy, in Tom Lee's ETH DAD, in our own Solana company, has been the number of tokens per share. I would say that although, the past cycles are indicative or predictive of, how it's gone in the past, the regulatory changes in the U.S., I think, just trump everything. They're just huge. And so I think we still have another leg to this rally to go. And so I think if all these endowments come in, all these sovereigns come in that we're seeing, frankly, we're going to put the money to work, right? Because when we raise the money, we're not going to sit around for 5 years. We're going to do it, and our peers are going to do the same. So I think the next 6 to 12 months are still big rally. And again, I know it it could. I know
it's horrible because you don't want to be hung by the internet by saying you said it was going to extend, but I think it's going to extend.
Yeah. So the fun fact on the markets is, when it has peaked in the past, is when we've all been the most bullish, right? After, 8 or 10 of these people talking about how they're changing the world, robotic, autonomous quadruped dogs and stuff, like super, super cutting edge stuff. And if you don't have, 8 or 10% of your assets in blockchain, you're going to want to slip out of that conference and call your broker, right? Like,
I've always said that it's like anybody who doesn't have a position, it feels like you're short the upside calls.
Yeah.
And you just have this horrible feeling all the time. It's like, I need to buy those back.
No, you do. And one of the kind of telling kind of dynamics in our industry is there's so many times people say, hey, aren't you worried that such and such smart, manager still hates Bitcoin? That's the upside. They're short. They're going to buy. And I was on a panel at the FII conference in Riyadh, Saudi Arabia, with literally the heads of all the super amazing public alts managers, right? Almost all of them were like, oh no, Bitcoin's a fad. I'm just like, I've been hearing that for 12 years. And I'm so bullish because you're a very smart person. And someday you're going to spend a couple weekends reading about crypto and you're going to go, uh-oh, I got to buy some of this. And you're going to put your $110 billion firm into our space. And that is why I'm so bullish. There's still so many really smart people that are still just so skeptical and negative. And I encounter them all the time.
Dan Morehead explained how the current U.S. administration views stablecoins favorably, noting that 99.6% of them are backed by U.S. treasuries, making their popularity beneficial for the country. He explained that this alignment boosts dollar dominance and opens up major opportunities in the financial system, where issuers are racing to capitalize. Another key trend is tokenizing assets, which everyone from NASDAQ to Robinhood is pursuing at a rapid pace. He cautioned, however, that blockchain won't transform everything overnight. Dan Morehead emphasized that assets need homogeneity and ubiquity to thrive on blockchain. U.S. treasuries exemplify this. They're uniform and globally demanded, providing easy access to dollars with interest. He pointed out that other assets, like commercial real estate, lag due to illiquidity and other barriers, though everything may eventually migrate there if regulators support stocks on the chain. He described digital asset treasuries, DATs, as vital access tools for investors restricted by traditional vehicles like 40 Act funds or basic brokerage accounts. He also argued they're often superior to ETFs because ETFs remain inert, trading at par without generating extra yields or increasing assets per share. In contrast, DATs can outperform through staking income, multiple expansion, and growing tokens per share. Dan Morehead observed that attending blockchain conferences reveals cutting-edge innovations, from robotic advancements to tokenized real-world assets, urging anyone without 8 to 10% portfolio exposure to act quickly or risk feeling perpetually short on upside. He noted a common industry dynamic. Skeptics among top asset managers still dismiss Bitcoin, but Morehead sees this as bullish, predicting they'll eventually dive in after studying it, injecting billions from firms like their $110 billion operations into the space. As we conclude, what are your thoughts on this interview? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.